Mike Assail from New York City. In the mistake du jour section of the annual report, you mentioned a fundamental rule of economics that you missed. I'd like to know the 2 or 3 most important fundamental rules of economics you habitually get right. In other words, what are the fundamental rules of economics you used to make money for Berkshire? And I'm not talking about Ben Graham's principles here, but rather rules of economics which may be found in an economics textbook. Thank you.
We try to, we try to follow Ben's principles in terms of the attitude we bring toward both investing and in buying businesses. But the most important thing you can, what we're trying to do is we're trying to find a business with a wide and long-lasting moat around it, protecting a terrific economic castle with an honest lord in charge of the castle. And in essence, that's what business is all about. I mean, you may want to be the lord of the castle yourself, in which case you don't worry about that last factor. But what we're trying to find is a business that, for one reason or another, it can be because it's the low-cost producer in some area. It can be because it has a natural franchise, because of service capabilities. It could be because of its position in the consumer's mind. It can be because of a technological advantage, for any kind of reason at all, that it has this moat around it. And then what we have to decide is all moats are subject to attack in a capitalistic system. So everybody is going to try. If you've got a big castle in there, people are going to be trying to figure out how to get to it. And what we have to decide. And most moats aren't worth a damn in capitalism. I mean, that's the nature of it, and it's a constructive thing that that's the case. But we are trying to figure out why is that castle still standing, and what's going to keep it standing or cause it not to be standing 5, 10, 20 years from now. What are the key factors, and how permanent are they? How much do they depend on the genius of the lord in the castle? And then if we feel good about the moat, then we try to figure out whether the lord is going to try and take it all for himself, or whether he's likely to do something stupid with the proceeds, etc. But that's the way we look at businesses. Charlie, you want to add anything?
Well, I think he wants it translated into the ordinary terms of economics. The honest lord is low agency costs. That's the word in economics. And the microeconomic business advantages are, by and large, advantages of scale. Scale of market dominance, which can be a retailer that just has huge advantages in terms of buying cheaper and enjoying higher sales per square foot. So by and large, you're talking economies of scale. You can have scale of intelligence. In other words, you can have a lord with enough extra intelligence that he has a big advantage. So by and large, you're talking scale advantages and low agency costs.
Yeah, to some extent, Charlie and I try and distinguish between businesses where you have to have been smart once and businesses where you have to stay smart. And retailing is a good case of a business where you have to stay smart. But, you are under attack all of the time. People are in your store. If you're doing something successful, they're in your store the next day trying to figure out what it is about your success that they can transplant and maybe add a little something on in their own situation. So you cannot coast in retailing. There are other businesses where you only have to be smart once, at least for a very long time. There was once a Southern publisher who was doing very well with his newspaper, and someone asked him the secret of his success, and he said, monopoly and nepotism. And he wasn't so dumb. He didn't have any illusions about himself. And if you had a big network of television affiliate station 30 years ago, there's still a major difference between good management and bad management. I mean, a major difference. But you could be a terrible manager and make a fortune, basically, because the one decision to own the network TV affiliate overcame almost any deficiency that existed from that point forward. And that would not be true if you were the first one to come up with some concept in retailing or something of the sort. I mean, you would have to be out there defending it every day. Ideally, you know, is you want terrific management at a terrific business, and that's what we look for. But as we pointed out in the past, if you have to choose between the two, get a terrific business. Charlie, any more? No.
Chairman, most company Berkshire invest at this time are not in high technology sector. What we have seen in the last few years, that there seems to be a significant growth both in sales and earnings of the high technology area. And also what your shareholder believe, that the times are changing from a brand name to high technology. My question is, can someone apply your investment principle, business philosophy, and your discipline in life to build a portfolio of, say, 5 or 6 high technology company? Let's call it Berkshire Hathaway Technology Fund.
Well, I think it would sell. The question about Charlie and I won't be able to do it. Charlie probably understands high tech, but you can see how hard it is to get any information out of him. So he hasn't told me yet. We try not to get into things that we don't understand. And if we're going to lose your money, we want to be able to come before you, next year and tell you we lost your money because we thought this and it turned out to be that. We don't want to say, somebody wrote us a report saying if, this is what's going to happen in some field that we don't understand and that therefore we lost your money by following someone else's advice. So we won't do it ourselves. I think that I think Ben Graham's principles are perfectly valid when applied to high-tech companies. It's that we don't know how to do it, but that doesn't mean somebody else doesn't know how to do it. My guess is that if Bill Gates were thinking about that he understood and that I didn't understand, he would apply much the same way of thinking about the investment decision that I would. He would just He would just understand the business. I might think I understand Coca-Cola or Gillette, and he may have the ability to understand a lot of other businesses that seem as clear to him as Coke or Gillette would seem to me. I think once he identified those, he would apply pretty much the same yardsticks in deciding how to act. I think he would act. I think he would have a margin of safety principle. It might be a little different because there's essentially more risk in a high-tech company, but he would still have the margin of safety principle on a sort of adjusted for the mathematical risk of loss in his mind. He would have he would look at it as a business, not as a stock. He would not buy it on borrowed money. I mean, a bunch of principles would be carried through. But our circle of things we understand is really unlikely to enlarge. Maybe a tiny bit here or there, but if the capital doesn't get too large, the circle's okay. I mean, but we will not. If we have trouble finding things within our circle, we will not enlarge the circle. We'll wait. That's our approach.
Ben Graham Investing encouraged turnover. Looking at Berkshire's holdings, concentration, and long term, are you still a 15% Phil Fisher and 85% Graham?
I don't know what the percentage would be. I'm 100% Ben Graham in those 3 points I mentioned earlier, and those really count. I was very influenced by Phil Fisher when I first read his 2 books back around 1960 or thereabouts, and I think that they're terrific books. I think Phil is a terrific guy. So I think I probably gave that percentage to, I I think I first used it in Forbes one time when Jim Michaels wrote me, and I think it was one of those things I just named a number. But I think I'd rather think of myself as being a sort of 100% Ben Graham and 100% Phil Fisher, in the points where they don't, and they really don't contradict each other. It's just that they had a vastly different emphasis. Ben would not have disagreed with the proposition that if you can find a business with a high rate of return on capital that can keep using more capital on that's the best business in the world. And of course, he made most of his money out of Geico, which was precisely that sort of business. So he recognized it. It's just that he felt that the other system of buying things that were statistically very cheap and buying a large number of them was an easier policy to apply, and one that was a little more teachable. He would have felt that Phil Fisher's approach was less teachable than his, but his had a more limited value because it was not workable with really large sums of money. At Graham Newman Corp was a closed-end fund. It was technically an open-end fund, but it had $6 million of net worth, and Newman and Graham, the partnership that was affiliated with it, had $6 million. So you had a total pool of $12 million. Well, you could go around buying little machine tool stocks in machine tool companies, whatever it might be, that all statistically cheap, and that was a very good group operation. And if you own a lousy business, you have to sell it at some point. I mean, if you own a group of lousy businesses, you better hope some of them get taken over or something happens. You need turnover. If you own a wonderful business, you don't want turnover, basically. Charlie?
What was interesting to me about the Phil Fisher businesses is that a very great many of them didn't last as wonderful businesses. One of his businesses was Title Insurance and Trust Company, which dominated the state of California. It had the biggest title plant, which was maintained by hand, and it had great fiscal solvency and integrity and so forth. It just dominated a lucrative field. And along came the computer. And now you could create, for a few $1 million, a title plant and keep it up without an army of clerks. And pretty soon we had 20 different title companies, and they would go to great big customers like big lenders and big real estate brokers and pay them outlandish commissions by the standards of yore, and bid away huge blocks of business. And in due course, in the state of California, the aggregate earnings of all the title insurance companies combined went below zero, starting with a virtual monopoly.
So what looked like a monopoly.
Very few companies are so safe that you can just look ahead 20 years. And technology is sometimes your friend and it's sometimes your bitter enemy. If Title Insurance and Trust Company had been smart, they would have looked on that computer, which they saw as a cost reducer, as one of the worst curses that ever came to man.
It probably takes more business experience and insights to some degree to apply Phil Fisher's approach than it does Graham's approach. The only problem is you may be shut out of doing anything for a long time with Ben's approach, and you may have a lot of difficulty in doing it with big money. But if you strictly applied, for example, his working capital test to security, it will work. It just may not work on a very big scale, and there may be periods when you're not doing much. Ben really was more of a teacher than he had no urge to make a lot of money. It did not interest him. So he really wanted something that he thought was teachable as a cornerstone of his philosophy or approach. And he felt you could read his books sitting out here in Omaha and apply buying things that were statistically cheap, and you didn't have to have any special insights about business or consumer behavior or anything of the sort. And I don't think there's any question about that being true, but I also don't think you can manage lots of money in accord with it.